Look at your screen right now. Just look at it. Because what happened to silver in February 2026 was not a correction. It was not a repricing. It was not the market doing what markets do. What you witnessed was a financial assassination carried out in broad daylight while Bloomberg ran their usual headlines about Fed policy and yield curves and whatever distraction they had queued up that morning. I need you to stay with me for the next 20 minutes because what I am about to walk you through is going to completely reframe how you understand the silver market. And I am not using that word lightly. I mean reframe. I mean the picture you had in your head about what this market is and how it functions and who controls it and why the price moves the way it does, that picture is wrong. And today I am going to show you the correct picture. Let me start with the price action because that is where the crime scene begins. Silver was trading north of $120 per ounce. 120. You have to understand what that number represented. That was not a bubble. That was not speculation run amok. That was a metal with a global annual mining supply of roughly 900 million ounces, being consumed at a rate that has exceeded mine supply for 3 consecutive years, finally being allowed to breathe toward its true fundamental value. And then, in the span of a few trading sessions, it got cut almost in half, down to $64. A 53% drawdown in days. And the financial press, every single outlet from Reuters to MarketWatch to Bloomberg, they all ran the same headline. They all pointed to the same explanation. Kevin Warsh. For those who do not know the name, Kevin Warsh is the incoming Federal Reserve Chair nominee. And the story that was sold to you, the story the media agreed on, all of them, simultaneously, as if someone sent a memo, was that the market was repricing silver based on expectations that Warsh would be more hawkish, more aggressive on interest rates, more committed to a strong dollar. And therefore silver, which is priced in dollars, was going to face headwinds. That is the official narrative. That is the story they want you to believe. That is the explanation that is designed to make you feel like what happened was rational, was logical, was just the market being the market. But here is where the story breaks. Here is where the narrative cracks. Here is where you have to slow down and actually look at the evidence instead of accepting the headline. Because if silver crashed because nobody wants silver, if the price fell because demand evaporated and investors were running for the exits, then the physical silver sitting in COMEX vaults should have stayed there. Or it should have increased. That is how markets work. Low demand means inventory builds up. Low demand means the warehouses get fuller. That is not an opinion, that is physics. That is supply and demand in its most basic form. So let me ask you the question that the financial media is not asking. If nobody wants silver, why did 33 million ounces of physical silver disappear from COMEX registered vaults in the exact same week the price crashed? Not over a month. Not over a quarter. 1 week. 33 million ounces. Gone. Physically removed from warehouses. Physically withdrawn. You do not withdraw 33 million ounces of something that you do not want. You do not go to the vault and say, "Give me the metal nobody wants and I will take it off your hands." That is not how human beings behave. That is not how institutions behave. That is not how any rational actor in any market behaves. And yet that is precisely what happened. Think about what I just said. The price crashed. Retail investors panicked. Small traders liquidated their positions. Sentiment turned negative. And while all of that was happening on the surface, while the retail money was running for the exits because the Warsh narrative scared them, underneath the surface, in the vaults, somebody was grabbing every single ounce they could get their hands on at the artificially depressed price. Somebody knew. Somebody orchestrated this. This was not a coincidence. This was a trap. And the retail investor was the prey. That is the crime scene. That is what I am talking about when I say you witnessed a financial assassination. The price was the weapon. The Warsh narrative was the cover story. And the 33 million ounces that vanished from COMEX is the body at the scene. Now let's talk about who pulled the trigger and why this specific moment in time was chosen. To understand the timing, you have to understand what is coming in March 2026, and I mean what is physically, contractually, mathematically coming. Not what might happen, not a prediction, not a thesis, a deadline, a date on a calendar that cannot be renegotiated, cannot be postponed, cannot be wished away by Fed policy or interest rate rhetoric or any other narrative the media wants to deploy. The COMEX operates on a futures contract system. You buy a contract for silver delivery, and that contract has a settlement month. March 2026 is a major delivery month for silver futures. And the analysts who actually track these things, not the Bloomberg analysts, not the CNBC talking heads, I am talking about the people who sit down with the actual data from the exchange they are projecting, that delivery requests for the March contract cycle are going to come in somewhere between 70 and 80 million ounces. Let me say that again slowly. 70 to 80 million ounces of physical silver. That is what people are going to show up and ask for. Ounce in hand. Give me my metal. Now, hold that number in your head. 70 to 80 million ounces. I am going to come back to it in a few minutes, and I am going to show you exactly why that number is a problem. But first I need to explain the mechanism, because this is where most people's eyes glaze over. This is where most financial content throws up its hands and says it is complicated and moves on. I am not going to do that. I am going to explain this precisely because understanding the mechanism is the difference between seeing this as noise and understanding it as the biggest story in the commodity markets right now. The COMEX, like most commodity exchanges, operates on what is called fractional reserve. That term should sound familiar because it is the same term we use for banks. Your bank does not hold every dollar you deposited. It holds a fraction and lends out the rest. The COMEX does the same thing with metal. They issue paper contracts representing silver they do not physically have. They sell promises, they sell IOUs. They have been doing this for decades, and it works as long as the overwhelming majority of contract holders never ask for delivery. Most traders on the COMEX are speculators. They want exposure to the silver price. They do not want actual bars of metal showing up at their door. They will roll their contracts, take cash settlement, and never touch physical silver. The exchange knows this. It has always relied on this. But here is what has changed. Here is the variable that breaks the model. The percentage of contracts that are being stood for delivery actually requesting the physical metal instead of rolling or settling in cash has been rising. And it has been rising in a way that the exchange's fractional reserve assumptions were not designed to handle, because the people standing for delivery now are not speculators. They are not retail traders who can be talked into taking a cash payment. The new class of buyers demanding physical metal includes sovereign wealth funds, central banks of emerging market nations, industrial consumers who need the actual metal for manufacturing, and increasingly, as I am going to get to in a moment, technology companies that need silver for applications where there is no substitute. These are buyers who will take delivery. These are buyers for whom a cash equivalent is not acceptable. And here is the thing about fractional reserve systems. They work perfectly until they do not. They work perfectly until the percentage of people asking for their money, or in this case their metal, exceeds the fraction that is actually held in reserve. When that happens, you do not get a smooth adjustment. You do not get an orderly repricing. You get a run. You get a cascade. You get a moment where the entire fiction of the paper market collides with the physical reality of what is actually in the vault, and the fiction loses. That collision is scheduled for March. And the people who know that, the people who set this trap, they needed retail to sell cheap so they could cover their shorts and acquire physical before the deadline. That is what the Warsh crash was. That is the whole game. Now let me show you the most powerful piece of evidence for what I just described. And this is the broken arbitrage. This is the thing that should have every serious market participant asking questions, but instead it is being met with silence from every major financial outlet. Here is how the silver market is supposed to work globally. You have essentially two major benchmark prices. You have the COMEX price in New York, denominated in US dollars, which is the Western paper market price. And you have the Shanghai Futures Exchange price in China, denominated in Chinese yuan, which represents the Eastern physical market price. Under normal functioning market conditions, these two prices should be very close to each other. Why? Because of arbitrage. Because if the price in Shanghai is significantly higher than the price in New York, traders will buy in New York and ship metal to Shanghai and sell it there, pocketing the difference. That arbitrage trade is the mechanism that equalizes prices globally. It is the mechanism that makes the price of silver in Shanghai and the price of silver in New York converge toward the same number over time. It has worked for decades. It is the foundation of how globally traded commodities are priced. Right now, as I am recording this, the COMEX spot price for silver is approximately $82 per ounce. The Shanghai silver price, converting from yuan to dollars at current exchange rates, is sitting between $93 and $104 per ounce. That is a gap of between $11 and $22 per ounce. Let me say that more simply. You can buy silver in New York for $82 and sell it in Shanghai for somewhere between $93 and $104. That is a guaranteed profit on every single ounce. No risk. No speculation. Pure arbitrage. You buy here, you ship there, you sell there, you pocket the spread. Elementary. So why is this gap not closing? Why are traders not flooding New York with buy orders and flooding Shanghai with sell orders and closing this spread in a matter of hours the way arbitrage is supposed to work? Why is this premium persisting? Why is it growing? There is only one answer, and it is the answer that explains everything. The metal is not available to ship. The metal that would need to flow from west to east to close this arbitrage, it is already gone. It has already moved. The vaults are not deep enough. The registered inventory at COMEX, the metal that is actually available and eligible for delivery under futures contracts, is not sufficient to support the volume of arbitrage that would be required to close an $11 to $22 spread. The flow is one direction, west to east. And it is not reversible because there is nothing left in the west to send. This is not a normal market inefficiency. Normal market inefficiencies last hours, maybe days before arbitrage corrects them. This gap has been widening for weeks. A persistent growing price spread between two markets for the same physical commodity that cannot be closed by arbitrage is not an inefficiency. It is evidence of a physical shortage. It is evidence that the paper price in New York has decoupled from physical reality. It is evidence that the number on your screen when you look up the silver price is a fiction, a useful fiction for the banks. A devastating fiction for anyone who thinks they own silver via a futures contract and plans to take delivery of metal that may not exist. Let me now give you the actual numbers because I want you to understand the scale of what I am describing. I want you to be able to do this math yourself because when you see these numbers, you will never look at the COMEX silver market the same way again. COMEX total open interest for silver futures contracts, as of recent reporting, stands at 429 million ounces. 429 million ounces. That is the total face value of all outstanding paper silver contracts on the exchange. Every futures contract, every forward, every obligation on the books. 429 million ounces worth of paper claims. Now let me tell you how much physical silver is sitting in COMEX registered vaults. Registered is the critical word here. There are two categories of silver on the COMEX. There is eligible silver, which is silver that meets exchange specifications and is physically sitting in approved warehouses, but which has not been specifically designated for delivery under a futures contract. Eligible silver is essentially privately held metal that is being stored in COMEX-approved facilities. And then there is registered silver. Registered silver is the metal that has been specifically earmarked, specifically set aside, specifically designated to back futures contracts and be available for delivery. Registered silver is the metal that actually counts when someone walks up and says, "Give me my metal." Total registered silver at COMEX right now, approximately 103 million ounces. 103 million ounces standing behind 429 million ounces of paper promises. Do that division with me. 429 divided by 103, that is a ratio of 4.16 to 1. There are 4.16 paper claims for every single real physical ounce sitting in those vaults. That is a leverage ratio of 416%. 416%. And I want you to understand that number in historical context because this is where it gets truly alarming. Go back 5 years. Go back to 2021 to 2022. The leverage ratio on the COMEX was elevated, but it was manageable. We were seeing ratios in the range of 150 to 200%, meaning roughly 1.5 to 2 paper claims per real ounce. Still a fractional reserve system. Still technically a fiction, but a manageable fiction. A fiction that the exchange could maintain without immediate crisis. That ratio has more than doubled. We have gone from 1.5 to 2 to 1 to 4 to 1 in roughly 4 years. The pace of leverage accumulation is accelerating. The gap between paper and physical is not slowly widening. It is widening at an exponential rate. And now here is the number that ties everything together. Here is the number that explains why February's crash was a trap and why March is the deadline. In the same week that silver's price crashed 50% on the Warsh narrative, the registered COMEX inventory dropped by 26%. 26% of the remaining registered stock vanished in a single week. We went from roughly 139 million ounces of registered silver to 103 million ounces. That is a bleed of 36 million ounces. 1 week, while the price was being suppressed, while retail was selling in panic, the drawdown accelerated, the vaults emptied faster. And the people doing the withdrawing were doing it quietly, efficiently, at prices that were artificially depressed. That is not a coincidence. That is a coordinated extraction. Now let me contextualize the coming delivery demand against current inventory because this math is where the story ends and reality begins. Analysts are projecting 70 to 80 million ounces of delivery requests for the March contract. Let us use the conservative number, 70 million ounces. COMEX registered inventory right now, 103 million ounces. So theoretically, the exchange can cover the delivery requests, right? 103 minus 70 is 33, so there is a buffer. But this is where you have to think more carefully, because that 103 million ounces figure was the number after the 26% drawdown we just discussed. That number will not stay static between now and March. The drawdown is continuing. Every day that passes, more metal is being moved out of registered status. We are on a trajectory. If the weekly withdrawal rate even approaches what we saw in February, the registered inventory could be in the 60 to 70 million ounce range by the time March delivery begins. And 60 to 70 million ounces standing against 70 to 80 million ounces of delivery requests is not a buffer. That is a default. That is a mathematical impossibility. That is the moment the fiction meets the wall. And here is what no one is telling you about what happens next. When a commodity exchange faces a situation where they cannot physically deliver the metal that contract holders have a legal right to demand, they have options. And none of those options are good for you if you hold paper silver and are expecting metal. Option 1 is force majeure. The exchange declares a market emergency and invokes extraordinary procedures. Delivery is suspended, contracts are frozen. You hold a contract that says you are owed silver and you cannot get it. The exchange will argue that circumstances beyond their control created the situation. History shows that when exchanges invoke force majeure, small traders and retail investors bear the cost. Institutions with legal firepower and political connections get made whole. You do not. Option 2 is cash settlement. The exchange decides, unilaterally, that instead of delivering physical metal to contract holders, they will pay out the dollar value of the contract at some determined settlement price. The problem with cash settlement, when you are dealing with a metal that has a physical premium of $10 to $22 above the paper price, is that you are being compensated in fiat currency at the fraudulent paper price. Not at the price that actual physical silver is trading hands for in Shanghai, not at the price that a buyer and seller of real metal would agree on in an arm's-length transaction. You receive dollars that are worth less than the metal you were owed. You are paid in the currency that is the reason people buy silver in the first place. You are robbed using the instrument you bought silver to protect yourself from. Option 3, and this is the most historically precedented, is what happened in the nickel market in March 2022. I want to spend time on this because this is your preview. This is your warning shot. In March 2022, nickel prices on the London Metal Exchange had been rising sharply due to supply disruptions related to the conflict in Ukraine. A Chinese nickel producer named Tsingshan Holding Group had a massive short position. They had sold nickel futures contracts betting that prices would fall. When the price instead exploded upward, reaching over $100,000 per metric ton, Tsingshan faced what is called a short squeeze. They needed to buy nickel contracts to cover their short position, but every purchase pushed the price higher, which forced more buying, which pushed the price even higher. It was a liquidity cascade, a self-reinforcing cycle of destruction. The London Metal Exchange's response was extraordinary. They suspended trading. They canceled trades. They annulled billions of dollars worth of executed transactions that had already cleared. They effectively rewound the tape on trades that had already happened because the outcome was inconvenient for their members. Traders who had correctly called the nickel squeeze, who had positioned properly and were owed massive profits, woke up to find their trades had been erased. The exchange intervened to protect the shorts, to protect the institutions, to protect the system, and the retail investors and smaller funds who had correctly analyzed the market paid the price. This is your playbook for March 2026 silver. If delivery demands exceed inventory, the exchange does not simply honor its obligations and run dry. It changes the rules. It suspends trading. It forces cash settlement at the suppressed paper price. It does whatever is necessary to prevent the physical delivery from completing, because once the physical delivery fails, once the world sees that the COMEX cannot deliver the silver it promised, the entire paper derivatives market for silver collapses. 35 years of financial engineering disappears overnight, and every paper claim holder discovers simultaneously that they own nothing. Now let me talk about the buyers, because I have been focusing on the squeeze dynamic and the delivery risk, but I want to explain why the demand side of this equation is structurally different from any previous silver squeeze in history. And this is the part that the gold and silver community has been slow to fully internalize, because we are used to talking about silver demand in terms of investment demand, monetary demand, safe haven buying. We are used to the thesis that silver is undervalued as money, and that eventually the market will recognize its monetary premium. That thesis is still valid. But there is a second demand story running in parallel that is completely divorced from monetary considerations, and it is consuming silver at a pace that is genuinely threatening the supply picture. I am talking about industrial demand. Specifically, I am talking about two sectors that have emerged as structural, price-insensitive buyers of silver in a way that has never existed before in the history of the silver market. And I want to be specific about what price-insensitive means. It means they will buy silver regardless of whether the price is $80 or $150 or $300. It means their demand does not shrink when the price rises because silver is not a cost center for their business model. It is a critical input, it is a technical requirement, and there is no substitute. The first sector is solar energy. Photovoltaic solar panels require silver paste as a conductor. The silver content per panel has been falling as manufacturers have worked to reduce material costs, but the total number of panels being manufactured has been growing at a rate that more than offsets the per-panel efficiency gains. Global solar panel installations are running at record levels. China alone is installing solar capacity at a pace that was unimaginable 5 years ago. And every gigawatt of solar capacity requires silver. The relationship is linear. More solar equals more silver consumed. And the solar build-out is not slowing down. It is accelerating. The second sector is artificial intelligence infrastructure, and this is the one that is genuinely new. This is the demand driver that did not exist in any meaningful way even 2 years ago and is now becoming a significant factor in the physical silver supply picture. AI data centers require massive amounts of electrical infrastructure. The power density of a modern AI training cluster is extraordinary. We are talking about facilities that consume as much electricity as small cities. All of that power infrastructure, all of those server racks, all of that cooling infrastructure, all of the high-frequency switching and signal processing that happens inside an AI data center, it requires silver for its electrical contacts, for its thermal management components, for its high-reliability connectors. Silver is the most electrically conductive metal on the periodic table. In applications where electrical resistance matters, where heat management matters, where signal integrity matters, silver is not optional. There is no substitute that performs as well. And the AI build-out is not buying silver through COMEX. This is critical. These industrial buyers are not speculating on silver futures. They are not taking long positions hoping for a price gain. They are going directly to refiners and bullion dealers and locking in supply contracts for physical metal because their capital expenditure programs require it. They are bypassing the paper market entirely. They are buying physical silver in quantities that do not show up in the COMEX open interest data. They are invisible to the exchange statistics, and yet they are consuming real physical supply. When you add sovereign central bank buying, investment demand from institutional stackers responding to dollar debasement concerns, solar energy demand, and AI data center demand, you get a picture of total global silver demand that structurally exceeds mine supply on an annual basis. Not marginally. Not in a way that can be corrected by marginal price adjustments. On a sustained, multi-year basis, the deficit between what mines produce and what the world consumes has been drawing down above-ground inventories. And those inventories, the COMEX inventories, the LBMA inventories in London, the Shanghai warehouse inventories, they are measurably smaller today than they were 3 years ago, 5 years ago. The direction of travel is unambiguous. The trend is your enemy if you are short silver. The trend is your friend if you hold physical. Now I need to take you back in time, because I know some of you watching this are thinking that this all sounds dramatic, that the COMEX has existed for decades, that these leverage ratios have always been elevated, that the silver market has seen squeezes before and resolved without the catastrophe I am describing. And you are right that the market has survived previous stress events. But I want to show you why this time is structurally different, and I want to do it by showing you what happened in the past. Go back to 1971, August 15th. Richard Nixon appears on national television and announces that the United States is suspending the convertibility of the dollar into gold. The Bretton Woods Agreement, the post-war framework under which the dollar was backed by gold at a fixed rate of $35 per ounce, is unilaterally terminated. Nixon called it a temporary measure. 55 years later, the temporary measure is still in effect. What he did that night was remove the last physical anchor from the global monetary system. The dollar ceased to be a claim on a physical commodity and became what it remains today, a claim on the full faith and credit of the United States government, which is to say, a promise. A piece of paper that has value because other people believe it has value. What happened to gold after 1971? The price went from $35 per ounce to $875 per ounce by 1980. A 25 times increase in 9 years. Because the moment the gold window closed, every dollar ever printed became a pure fiat currency, and the market began the long process of repricing real assets against an untethered monetary unit. Silver followed the same path. Silver went from under $2 per ounce in 1971 to nearly $50 in 1980, a 25-to-1 ratio over the same period. Now, I am not predicting those exact ratios are going to repeat. Circumstances are different, the starting conditions are different, but the underlying mechanism, the repricing of physical assets against a debasing currency when the physical anchor is removed or undermined, that mechanism is eternal. It does not change because we have computers now. It does not change because we have derivatives now. Physical reality reasserts itself. It always has. It always will. Go back to the Hunt brothers, 1,979 and 1,980. Nelson Bunker Hunt and William Herbert Hunt and their Saudi partners began accumulating silver futures contracts and physical silver in enormous quantities. At the peak, they held positions representing roughly 130 million ounces of silver. In January 1980, silver hit $49.50 per ounce, which in today's purchasing power is equivalent to over $230. The Hunts had cornered approximately one-third of the world's total above-ground silver supply, and the exchange, COMEX, changed the rules. They imposed position limits. They restricted new long contracts. They allowed only liquidation trades. They effectively made it illegal for any new buyer to enter the long side of the market while leaving the shorts, the banks, the dealers, the exchange members free to maintain their positions. The price collapsed from $49 to $11 in a matter of weeks. The Hunts were ruined, the system was saved. And the lesson was cemented. When the physical squeeze threatens the paper infrastructure, the rules will change to protect the infrastructure. Now, here is what is different in 2026 compared to 1,980. The Hunts were two individuals and their partners. They could be identified. They could be targeted. They could have their margin calls accelerated and their positions force liquidated. The buyers today, who are draining physical silver inventories, are not two individuals. They are sovereign wealth funds of nations that do not answer to Washington. They are central banks that are not subject to CFTC margin calls. They are industrial corporations whose silver purchases are capital expenditure items on their balance sheets, not speculative financial positions. You cannot change the rules of the COMEX in a way that stops Apple or Samsung from buying silver for their products. You cannot issue a margin call to the People's Bank of China. You cannot impose position limits on a photovoltaic panel manufacturer. The buyer base has changed in a way that makes the 1,980 playbook much harder to execute. And here's the other variable that makes this structurally different from every previous silver stress event. In 1980, there were no smartphones transmitting real-time price data. There was no social media. There was no ability for retail investors globally to simultaneously see that the Shanghai price is $22 above the COMEX price and understand what that means. The information asymmetry that the big players depended on the asymmetry that allowed the manipulation to work in the dark is gone, or it is at least significantly reduced. Every silver stacker in Japan, in Germany, in Brazil, in Canada can look at their screen right now and see the same arbitrage that I am describing. They can understand what a 26% drawdown in registered inventory means. They can do the same leverage ratio math that I just walked you through. The transparency of modern information infrastructure is a variable that has never existed before in any previous precious metals stress event. So, where does this leave you? What should you actually do with this information? Because I am not here to entertain you. I am not here to get your watch time and your engagement metrics. I am here because I genuinely believe that what is about to happen in the silver market represents both a massive risk and a massive opportunity. And I want the people who follow this channel to be on the right side of it. The risk is straightforward. If you hold paper silver ETFs, futures contracts, unallocated accounts at bullion banks, you have counterparty risk. You have the risk that the entity on the other side of your paper claim will not deliver when asked. The COMEX leverage ratio tells you this risk is real. The Shanghai premium tells you this risk is real. The drawdown in registered inventory tells you this risk is real. Paper silver is not silver. Paper silver is a derivative contract that promises silver. And when the entity making that promise cannot keep it, you discover the difference between owning silver and owning a piece of paper that says you own silver. The opportunity is also straightforward. Physical silver at $82 per ounce, when Shanghai is paying between $93 and $104 for the same metal, is being sold at a discount to its true clearing price. When the paper market breaks, and I mean when, not if, the price discovery mechanism will shift from COMEX to the physical market. The arbitrage gap will close. But it will close by the paper price rising to meet the physical price, not the other way around, because you cannot conjure physical silver. You can conjure paper. You cannot conjure the real thing. The window is closing. I cannot tell you it closes in March. Maybe the exchange finds a way to manage through March. Maybe they shuffle enough metal between eligible and registered categories to paper over the immediate delivery demand. Maybe they negotiate with key contract holders to roll their positions rather than take delivery. These things are possible. What is not possible is for the structural deficit between paper claims and physical inventory to resolve without the price adjusting dramatically upward. The math does not permit any other outcome. You can delay it, you cannot avoid it. The Shanghai premium is not a data point. It is a signal flare. It is the market telling you that the price on your screen is wrong. It is telling you that in the one major market where you cannot pay off a delivery demand with a cash settlement because Chinese buyers are not interested in more dollars, they are paying $20 more than what the COMEX says silver is worth. Think about what that means. Think about why someone would pay $22 above the quoted price for something. They pay that premium because they need the metal. They pay that premium because the metal at the quoted price is not available. They pay that premium because scarcity is real and the paper price is not. Here is the plain English summary of everything I just told you. The COMEX issued 4.16 paper claims for every real ounce of silver. The price was manipulated down 50% to force retail selling and allow institutional buyers to cover shorts at depressed prices. 33 million ounces were extracted from the vaults during the price suppression. March delivery requests are projected to exceed or strain registered inventory. Shanghai is paying a persistent $20 premium over COMEX because the physical metal is not available to arbitrage the spread closed. Industrial demand from solar and AI is consuming silver at a rate that mining supply cannot match. When these dynamics converge in March, the fractional reserve system either holds through extraordinary measures or it breaks. If it breaks, the price discovery for silver moves from paper to physical, and the physical market is clearing at $20 to $22 above where your screen currently shows. Get physical possession before March. Not an ETF, not an unallocated account, not a futures contract. Metal in your hands, in a private vault in your name. The allocated and segregated variety, where you can verify by serial number that specific bars with specific weights are yours and only yours. Because the only silver that cannot be taken from you through cash settlement or force majeure or exchange rule changes or counterparty default is the silver that is physically yours and in your physical possession. The $10 premium in Shanghai is the alarm bell. It has been ringing for weeks. The financial media is not covering it. The talking heads on television are not discussing it. They are talking about Kevin Warsh and interest rate policy and yield curve management and every other piece of paper theater that keeps you distracted from the physical reality that is unfolding beneath the surface of the market. I have shown you the crime scene. I have shown you the evidence. I have done the math in public, the leverage ratio, the drawdown numbers, the arbitrage gap, the projected delivery demand. I have shown you the historical precedents. I have shown you what happens when the exchange decides the rules need to change to protect the system. And I have shown you who the new buyers are and why they cannot be stopped with the same tools that stopped the hunts in 1980. What you do with this information is up to you. But you asked me to follow the money, so I followed it. And the money, the smart money, the institutional money, the sovereign money, the Chinese money, it is buying physical silver at prices $22 above what your screen says it is worth. It is taking delivery. It is emptying the vaults. It is not rolling to paper. It is not accepting cash settlement. It is taking the metal. And it has been doing this while the narrative machine told you to sell. Follow the money. Always. Follow the money. That is it for today. If this analysis added value, share it with one person who needs to understand what is happening in the silver market right now. Not because I need the views. Because they need the information. The clock is running. March is not far. And the vaults are not getting fuller. Follow the money. I will see you in the next one.